As we come to the end of 2020, it's now time to gaze into the future, 2021 and 2022. And here I'll be focusing on the Reserve Bank interest rate policy and overall market rates. We're expecting that the Reserve Bank will extend its quantitative easing program, which is now due to expire early May, by another $100 billion that will take it to early November. And then we're expecting another 2 consecutive $50 billion programs to early May 2022 and early November 2022. We're also expecting that bond rates will be rising over the course of 2021 and 2022. We're looking at the Australian bond rate to rise to around 1.25%, the 10-year rate, and by the end of 2022 up to 1.7%. The Reserve Bank will maintain its 0.1% cash rate, but the yield curve control policy, which is fixing the 3-year bond rate at 0.1%, will have to be adjusted in 2022. And I would expect by the end of 2022 that policy will be targeting 0.3% for the 3-year bond rate rather than 0.1%. But the first big issue is going to be quantitative easing, and there's considerable amount of market speculation as to whether the Reserve Bank will extend the program that's due to expire in early May. I think the arguments are very strong to extend the program. Why did they firstly introduce the program? Concerns about other countries that are expanding their balance sheets and making the Australian dollar overvalued. So the Reserve Bank is trying to match those particular policies. We know there's a high degree of sensitivity about the value of the Australian dollar, and of course buying bonds holds down interest rates, and we know the governments have large borrowing programs. Prospects of other central banks cutting back on their own balance sheet expansion are very unlikely next year. We saw the Federal Reserve today give us comfort that they're very much expecting to be continuing to add $120 billion to their balance sheet every month for an extended period. I also think with Australia, with our forecast that the Australian dollar is going to 80 cents by the end of 2021, the Reserve Bank is at risk of feeling that that is pushing the dollar into an overvalued territory, and really quantitative easing is going to be the only policy that they'll have available to them to address that issue. The next issue is really, does the Reserve Bank have the capacity to add that much to their balance sheet? Well, quite frankly, they do. At the moment, the Reserve Bank's balance sheet is only 16% of GDP. That compares with 36% for the Fed, 24% for Canada, 28% for the UK, but they stopped counting back in 2019, and 60% for the ECB. And even if we were to see this addition to the term funding facility that we're expecting and these additional bond purchases, the balance sheet would still be less than 30% by that November period next year. So there's plenty of scope there. The Reserve Bank has also pointed out that since COVID, other central banks have been buying 50% of new bond issuance, and they've only been buying 25%. And that $100 billion extended program, along with the additional 50s, will have the Reserve Bank buying around about 50% of new issuance. We also think that the split between bonds and Australian government bonds and semis will change. For the first program that ends in May this year, the split is 80% Commonwealth government, 20% semis. I think for the next program it'll be 70% Commonwealth government, 30% semis, because even though the semis represent about 28% of total outstanding debt, scrutinising the deficit story for the semis relative to the Commonwealth government over the next couple of years is pointing out that semis will be representing around 35 to 36% of deficits relative to the 28% of existing stock. So I think there's an argument to say that you take another 30%, lift the semi share to 30%. So what might this all mean for negative interest rates? Well, think about the Reserve Bank's balance sheet. When they buy bonds, their assets go up, but what are their liabilities? The liabilities are deposits from the banks in the exchange settlement account. Reserve Bank is currently paying 0 on those rates. So as we get a bigger lift in the volume of bonds that the Reserve Bank is buying, so we'll see more funds that will be made available to the banks where the banks can only earn a 0%. So I would expect that we'll start to see negative short-term interest rates on wholesale deposit rates for institutions and for corporates. There's been some flavour of that already in a bond tender and in the forward rates, but I would expect it'll become much more of a common factor for next year. But you might be saying, Bill, why are you expecting an extension of QE when you've just lifted your growth forecasts? We certainly have. We expect growth next year will be 4% compared to 2.8% that we had before. We expect the unemployment rate will be down to 6% by the end of 2021 compared to 7%. And the end of 2022, we're expecting it to be down to 5.2% compared to a previous 6.3%. So faster growth and a lower unemployment profile, but still not low enough to satisfy the Reserve Bank in 2021. 6% by the end of 2021 is still in that territory, suggesting that there will be no pressure on wages and no help for the Reserve Bank to achieve their inflation target. So I think that decision to extend the program in May is going to be fairly comfortable. 2022 represents other challenges. By the end of 2022, we're saying that we think that the unemployment rate will be down to 5.2. I don't think it'll be possible for the Reserve Bank in 2022 to say that they expect to hold the cash rate at 0.1 for another 3 years. That's out to 2025. So I expect by then markets will also be putting pressure on the Reserve Bank in that regard, and it will be a sensible policy to edge up that target rate. And I would think in a couple of stages from the 0.1 at the beginning of the year to 0.3 by the end of the year. And that'll be consistent with a scaling back in the QE program from 100 billion to the 50 billion we're expecting in November and May next year.